Good afternoon. I'm Mike Carrazzo. I'm the content manager here at Ryerson, and thank you for joining us for another Cup of Joe. For those of you that attended last month, welcome back. As you know, what we're trying to do here is have a casual but engaging conversation around what's moving this crazy metals market. But for those of you that are new this month, thank you for joining us. And I'm joined, as always, by our Director of Risk Management and Commodities Hedging, Nick Webb. Nick, good afternoon.
Good afternoon.
A lot going on in the market, but before we dig in, I wanted to let everyone know, thank you, everyone, for joining us. We know that you can be anywhere on these crazy days right now, but it's nice to take a break and have a casual conversation about what might be really impacting this market. And it's interactive, as I mentioned. So at the bottom of your screen, you're going to see a Q&A button. Put in a question, and we'll save some time at the end. Hopefully, we can answer all your questions. And as always, like last time, the full session is recorded. So if for some reason you want to go back and listen, it'll be available on Ryerson.com as well as our YouTube channel. So, Nick, I know last time we talked about what you like to call a shortage of everything, and I got a feeling that's where you're going to want to start today, right?
Yeah, I mean, I wish I could bring a different commentary to the table here today, but unfortunately, if I'm bringing anything to the table, it's probably a further echoing of that entire sentiment. And as we've talked about in the past, I'm a little fearful that I'm going to start to put on a bit of a Dr. Doom hat here in this presentation. We'll see where we go, but yeah, if anything, I would say it's onwards and upwards with regards to prices, with regards to shortages and availability of most things. But we'll talk about that in more detail here in a bit.
Yeah, so you've got some great stuff you're going to dive in from the macro perspective, because I think there's a lot of things moving, and then we'll move into individually, right? What's moving: aluminum, carbon, and stainless. But I think really just kind of set the stage. I mean, there's some factors that are moving everything in general, right?
Yeah, I mean, I think we're seeing a little bit of a rising tide lifts all boats sort of thing. So we're going to spend the most time on the macro side, just because it really does tend to be a situation where all of this is very thematic around a lot of the same things. So if you can predict where one of the metals go, you're generally going to get all three of the primary ones that Ryerson touches right. Right now, that's all upward. So we've got a couple extra slides this month relative to what we would have had last month, and then we've got a lot of similar ones that we've just got updated prices and commentary on. So again, we'll probably spend the most of the time on the macro side. We'll dive in quickly through each of the individual metals, and then we'll take Q&A.
Great. Well, I got my cup of coffee here, so and I think it's got to be strong to hear what's going on in this market. So cheers, and cheers, everybody, and let's dive right into it, Nick.
Excellent. Yeah, it's 2:30 here in Chicago. When you get that 2:30 feeling, you either grab a 5-hour energy or grab a nice cup of Joe.
That's right.
Yeah, I'm going to go ahead and share my screen.
And while we set up, I do want to reiterate, there's that Q&A button down there. Feel free. We'll try to answer them as we go. But at the end, we'll save it for some of the questions that we really can't answer as we go through this.
Excellent. And I sincerely apologize. All right, here we go. I think I had too many screens open, so I was not able to find the PowerPoint presentation. That being said, we as always, to appease our legal team, we have to cover the safe harbor provision. As with the prior commentary, as with any of these commentaries, we want to make sure it's noted that anything we're talking about here may include forward-looking statements. This is not advice. This is not investment advice. This is just kind of how I see the world, how I'm watching things. This isn't a view of Ryerson. Do your own research. By all means, we think we've got some good information here that you can take away and have discussions internally within your own procurement teams, your own manufacturing teams, but we have to provide that for arm's length transactions or arm's length discussions. So with that said, we'll go ahead and hop into the macro side of things. So this is a 5-year chart. Again, we've seen this chart in the past, but this is the Bloomberg Commodities Metals Subindex, which that's a mouthful. That's a very fancy way of saying this is a basket of metals prices. And you can see that if we compare to where we would have been a month ago, we are higher than where we would have been 30 days ago. We're now in most cases at not just 5-year highs, but in many of the instances with manufactured products, we're at record high were record high prices. That's true of copper. That is true pretty much of aluminum ingot. We're within about a couple cents of all-time highs when you include the London Metal Exchange price with where Midwest premiums are. Iron ore prices just today hit a record high. They were up about 5%. They've now moved above $200 a metric ton. So we talked about it briefly at the onset of this discussion, but this is pretty unprecedented type stuff. And it doesn't seem to be getting better. If anything, it's getting worse in many instances. And it's spreading across more and more markets that we're seeing. And we'll talk about those here on this slide, just a couple of them. One that's gotten a fair amount of headlines, not just in the last couple of months, but maybe more predominantly in the last 2 weeks. That top left picture, that's an actual picture from just a couple of days ago in Kentucky. I believe that is the Kentucky Motor Speedway. And those are inventories of Ford Super Duty trucks. So here you have an industry, we've talked about it in the past, where the semiconductors are creating issues with finishing these cars. We talked about that at length a month ago. We got further commentary on Ford's last earnings call where they said they're expecting it to impact their production of all vehicles to the tune of 50%, 50, for all of Q2. They're further expecting, at least as of their earnings release, that it's going to impact about 10% of Q3 and Q4 automotive production. I hear that, I immediately think yikes, because obviously, big automotive buys not just steel, they buy, stainless steel, aluminum, rubber. They're buying pretty much all the commodities in a very, very big way. So to me, that screams yikes. Thus far, the way they're getting around that, and we talked about that in the previous call, is that they're doing a lot of work in process inventory. And you see that here in this image where, they're basically completing the vehicles. They're continuing to buy the commodities, assemble the vehicles with what they have, with the parts that they do have. And then they're putting it into these fields or in parking lots. I question how long that can go on for, because at some point you run out of parking lots and you run out of space to put these things. But it's an interesting thing, because here's a situation where this supply chain breakdown and the shortage of everything has actually brought at least one of the automotive makers almost to its knees. It's a $5 chip, and it's almost, it's bringing the auto industry, at least some of the companies, down to 50%. In addition to that, you've got the top right corner, you've got lumber prices, corn prices down in the bottom right, flatbed trucking indices. All those charts look pretty darn similar. And you could probably copy and paste another 20 or 30 other commodity markets, and they would look very, very similar to this. Everything's just gone full parabolic. I don't want to sound like a broken record, but it really is happening in many, many different markets. Interestingly enough, and this is one of the charts that we didn't discuss, the shortage of everything is now even spanning into labor markets. And that's a very peculiar one. I came across these charts just in the last 30 days, and it really had me scratching my head, because at least in terms of what we see here at Ryerson, there's no lack of demand for good labor and labor for our manufacturing facilities, labor for truck drivers. And what's fascinating is if we really focus on the right-hand chart, we talk about the V-shaped recovery all the time. Demand, for the most part, over the last 12 months has experienced a V-shaped recovery. You look at industrial production, we're basically back to pre-COVID levels. You look at mobility data, it's recovered heavily. But then you look at this chart on the right-hand side, which is the labor rate. So this is the number of employees who are in the workforce who just have a high school degree. So I have to be careful about how I say this, but oftentimes you would think that group of people who doesn't have a college degree, those would be the types of people who would be fit for restaurant work, or maybe grocery store work, or manufacturing type jobs, or truck driver jobs. Jobs that are very, very much so in demand right now, but yet here you see the labor participation going down since October. So massive head scratcher to me, because that kind of says, wait, why in the world would that not be continuing to move onward and upward, just like every other demand indice that we're watching? And in fact, it's actually going the opposite direction. So this is where I have to be kind of careful, because it does get a little political. We could have an economic debate for the next hour if we wanted to, but there is certainly, I believe, so maybe not certainly, I believe that there's an instance of we're now experiencing, or in the last 30 days, we've experienced a situation whereby 34% of the United States incomes are now coming by way of government transfer payments. So government checks going out to individuals. I believe there's a chance that, at least to some degree, those checks are keeping people out of the workforce for a longer period of time, or maybe even removing people out of the workforce, as we're seeing here on that right-hand side chart. So what's that mean for commodities? What's that mean for manufacturing markets? I think it means that as long as we continue to see these government payments going to some of those manufacturing type jobs and truck driver jobs and things like that, there isn't a real big incentive to get back to work. Now, how long does that play out? I don't know. That's a much more difficult question, because that gets into how much do we want to continue to be accommodative to the workforce. I tend to be of the opinion that kind of one of two things maybe brings these people back to work. One is you either stop the transfer payments from the government, which would all of a sudden spark people to be, incentivized to get back to work, or the alternative is, I think, companies like Ryerson, manufacturing companies, end users of metal products, may be forced to pay more for employees. So what better way to incentivize somebody to get back into the workforce than to pay them more money? Now, admittedly, there are still some concerns with the workforce with regards to safety, COVID, things like that. I think those fears are beginning to abate, and I would say maybe even not beginning to abate. I think they're kind of hopefully well behind us as people get more and more vaccinated. But it's a pretty peculiar chart. And even when you go to the left-hand side chart, which is total labor force, even that one is not showing a full-on V-shaped recovery. So again, it kind of fits this mold. And then we'll see another chart here in a few slides that'll look similar to these on the steel side. But I think it's truly a situation of we've got demand that's recovered. We've got a lot of excitement in the end markets, but yet the labor force participation is not yet catching up. And that's, I think that's going to be true whether you're talking about trucking, manufacturing, port workers, and that's just creating these bottlenecks. And I know I'm echoing myself a little bit when I talk about these things, but it's happening everywhere.
Yeah, I'm glad you started here, Nick, too, right? Because as you set the stage, we talk, of course, we're focused in the world of metal and obviously the shortages, but I think it's important to illustrate, right? I mean, everything from the cost of lumber, I mean, there are stats out there just how much that's added to the cost to build a home right now. And you're looking at the shortage of drivers. And I like the tie between that, and you bring something important to light that I don't think we're looking at is the labor force too. That labor force has a big impact on that slide you showed up with the shortage pretty much of everything.
Yeah, and it's a $1 trillion question, maybe even multi-trillion dollar question, because maybe there is an argument that we want to shift our economy to having, those subsidy payments going out to individuals, and maybe this is a new normal. I don't know that answer, but if that is the answer, then I think we have to figure out another alternative, which maybe is, I think we've talked about this in the past, but maybe it's further automation of things and actually supplanting some of that labor with automation. That's not going to be a short-term fix, though. That's going to be, probably 3, 5, 10-year type horizon thing that would supplant this type of labor force with automation. So it's a tricky thing. There's a chance maybe we start to see those government transfer payments come back down. People all of a sudden are incentivized to get back into the workforce. Maybe wages start to rise. But again, that raises the question of if wages rise, do we start to see wage inflation that ultimately feeds for just a continuation of these commodity price rallies? It's possible. But on that same note, this is another new chart for this month. This is the Goldman Sachs Financial Conditions Index. And again, kind of a mouthful of an index, but it's ultimately saying how loose or how accommodative are the current financial standards in the marketplace today relative to history. And according to this index, and this is going back to the early 1980s, this is the most accommodative we've ever seen financial market conditions, basically since the history of this index. This is as far back as I could go. So what does that mean? Money's easy, money's cheap, it's sloshing around everywhere. That oftentimes leads to increases in inflation, eventually wage inflation, but it's also causing the tightness of the availability of a lot of things. I kind of look at this chart and being the cynic that I am, I kind of say, well, let's take a step back. Are we being too accommodative? Do we need all of this accommodation at this stage in time when we're running out of things? I begin to question that pretty heavily, that, should we start to see interest rates begin to rise and maybe cool off some of these things? And I think those things are obviously at the forefront of the discussion within the Treasury, within the Fed. But there's a lot of accommodation, at least within the North American markets, that I think spur in a lot of this as well.
Nick, I apologize if you said it already, but what is the Y index measuring on this one here? Where we're at?
Yeah, it's just an index, so it's ultimately just using a baseline gauge of 100. So
gotcha.
So it doesn't represent dollars or anything like that. It's just an index. It's created by Goldman as a basket.
And this is the lowest point. It looks like we've been since this is when it started tracking. So exactly. Couple this with what you showed us in the labor charts, and that's kind of shedding some light on what could be, one of the causes to what's.
Yeah, and I want to be sympathetic a little bit, because it makes sense that we're being accommodative right now. Because if you compare the last 12 to 15 months and what we've been through, I think it warrants so much accommodation, and because this was not the fault of any one individual or anything like that. So to get people back on their feet and to jumpstart the economy again, it makes sense that we've been accommodative. But now we're seeing almost the opposite, where things maybe are starting to overheat. Maybe not even starting to overheat. Maybe we're deep into the overheating phase. When you got a quick aside, and when you have a cryptocurrency like Dogecoin, which was made as a fake product, it now has a market cap of $80 billion with a B. That's double what Ford's market cap is. You start to wonder if things are getting a little frothy, I think.
Cryptocurrency, maybe that's something you can give us a lesson on in the next cup of Joe.
I'd love to.
Put your answers in the Q&A for that one, please. We'll tee that one up.
But that's not to discount or discredit the fact that the demand recovery has been real. We've talked about this in the past, but going left to right, this is the purchasing manager data from May of last year through current. It doesn't take too much of an eye test to see that it's going very much so from red territory into deep green for most regions of the world. We talked last month about China potentially cooling. You can see those two yellow marks for February and March. They've recovered a little bit, so the Chinese data has recovered slightly, so it's still in growth territory. And we also, I think, talked about Mexico last month, where they were really having a tough go of it to getting out of the red territory. They're continuing to progress, but they continue to be the laggard within the demand data. But make no mistake about it. This is definitely, at least in part, due to demand recovering as well. It's not just accommodative Fed and things like that. That being said, I'll end the macro side by saying, how does this end? These shortages, can they go on forever? What could possibly pop the bubble? What could possibly slow this train down? One thing that possibly would be China kind of going the opposite direction and actually tightening their credit conditions. And this chart, we talked about this last month. We have a further data point of this. And we kind of talked last month about the fact that it was beginning to look the chart was beginning to look more and more like the last two cycles, which was big money in and then starting to roll over. We now have this later data point that's showing that China's continuing to tighten the reins on their credit conditions. So while the United States and maybe Europe tends to be very, very accommodative and loose with their economic standards, China's going the opposite direction, and they're actually trying to pop some of their infrastructure bubbles and risk-taking bubbles. And so again, we don't know exactly where this chart's going to go, but if we use prior cycles as a history, it looks like the downward trajectory is continuing. Why is this important? Again, China is 50 to 60% of global commodities demand. And if China is trying to cool down their own market, you can bet that would have an impact on the rest of the world's demand for commodities and the pricing of commodities. The unfortunate thing for those customers of ours out there is it doesn't tend to be immediate. This chart tends to lead commodity prices to the tune of about 9 to 12 months. So if you're trying to get an idea of if China were to cool things down enough and we eventually see that feed through to loosening commodity markets and lower prices, we may not expect that till maybe fourth quarter of this year, or maybe even first half of next year. And I think that, as we roll through time, that's beginning to look more and more like the base case. But if we're trying to figure out ways in which this current theme within North American metals markets, rolls over, this would be a big one. This would be one potential. The main other one that I think a lot of people are very concerned about is, when or if does the Fed begin to tighten? When do we see interest rates start to move higher to actually put, a little bit of water on the fire that we're seeing, which I think we'll probably see later this year, but we'll see. That's my personal opinion.
Nick, does any of this have any bearing on the talk about, domestic versus import, right? You look at China and you say that they, the chart here, because of the commodities production and consumption, but I know that could be on the mind of some of our viewers here, the import versus domestic. And I know some of the import prices have been coming down. Is that something you're keeping an eye on?
Yeah, sure. And I think maybe a good segue into this first chart, which is actually looking at exactly that, which is for the carbon markets. This is looking at hot rolled coil prices domestically relative to Chinese prices in the blue, and then European prices in the orange. And by all means, if we're in a tight metal market, and the next bastion of product is going to the import market, by all means, Ryerson, other trading partners, other service centers, they're going to seek whatever spigot they can to fill in those gaps. There continues to be a bit of a price incentive, and in some cases, maybe a bigger price incentive to go out and seek those markets. I think maybe even more so than the price incentive, there's just an availability incentive, because we're in an environment right now where domestic prices are so high. I mean, you've got carbon prices upwards of $1,500 a short ton. We're in an environment, really in all metals, aluminum and stainless are also in similar environments, where it's almost a function of, we don't care what we pay, we just need to make sure that we have availability, because as demand continues to recover, we're seeing a lot of our customers with pretty strong forecasts for second half. And if we're going to, and when I say if the market is going to meet those demand forecasts, we got to come up with some more metal somewhere. And if the domestic mills are being slow to bring it back online, which I think there's potentially some of that taking place, then yeah, we got to go to the import markets. So the downside of those is that, while you may get a potentially better price, the lead times on that product is longer. It tends to be 4 to 6 months in many cases. So getting that tends to have longer lags. So it can allow these rallies to last a little longer. Does that help answer your question, Mike?
Absolutely. Yeah. Thank you.
With that being said, this is a chart. It doesn't look identical to the labor chart, but I think it's worth giving the corollary. This is the U.S. capacity utilization of steel mills here within North America. And the reason why I say there's a correlation between this chart and the labor charts that I showed earlier is, for all intents and purposes, this is a V-shaped recovery in capacity utilization. That chart is pretty darn close back to where production levels would have been pre-COVID. But you can see just in the last couple months, basically all the 2021 months, the rate at which that's been recovering has really tapered off. We could get into some theories on why that may be. I think some of it may be slightly purposeful from the domestic mills to keep markets as tight as they can, because most of the domestic mills, they're publicly traded companies and they are profit generating organizations. They're trying to balance price and profit margins with production and market share. And do I think that they're playing that game of keeping some production at bay? Probably, I do. And I think you can see that evidenced here in this chart, where things have actually tapered off a little bit, where in fact, if they really wanted to run assets as hard as they could, I believe this chart could have a different trajectory. So that gets a little conspiratorial, but I think that's contributing a bit to all of what we're seeing, which is demand has recovered, supply has recovered. It's just supply hasn't quite recovered at the rate at which demand has, and that's where you get these short squeezes. You factor in the fact that labor's slow to come back, and labor's fine, sitting on their couch because they're getting a material percentage of their income from the government currently. It creates a pretty difficult storm. Now that can change, and then if we look at the carbon market trajectory and the market expectations is that it's still going to change, but I sound like a broken record. Every single month we update this chart, it continues to go upward and to the right. So this is the futures market for steel 6 months ago, 1 month ago, and today. And you look at this chart, there's still an expectation that over the next 2-3 months, we're actually going to see higher prices, not lower. Now, beyond that, there's a belief that we're going to see markets come back down. And that's for a number of the reasons that we've already talked about, which is production may continue to ramp up, imports may continue to arrive at a higher and higher clip. And there's an expectation that additional domestic mills are coming online over the summer months and into Q4, that there are hopes that those are going to eventually normalize prices. Now, you look at the back end of this futures market, all of a sudden we're starting to see a phenomenon where the long-term trajectory of where prices may fall to, that floor has been lifted. You know, that floor, if we looked at this chart 2-3 months ago, it would have been $600 or $700. It's now $1,000. And why is that? Well, for this chart right here, the price of scrap, so the price of actually producing steel, has risen by almost 100%. In some cases on this curve, a little bit more than 100%. So again, this is the same chart. This is busheling scrap going back 6 months, 1 month, and the current. And again, you see a trajectory where over the next couple months, there's an expectation that not only will scrap stay sideways, it's actually going to go up. I believe the expectation there is that there's going to be a greater need for scrap for two reasons. One, we continue to see a push towards green energy, and obviously the EAF production is a bit more green, as it's recycling steel rather than producing it from iron ore. So there's a little bit of a push that way. I think the other element, which is probably the bigger one, is that much of that new production here within North America that's expected to come online, that's EAF production. So that's just going to it will create more steel, but it's also going to create probably a greater demand for the raw ingredients, which would be scrap. So it's kind of a push and pull type situation where steel prices may come down, but the floor to which they may come down to may be lifted, maybe not just over the next couple of months, but maybe over a longer term horizon where, if we continue to see this new paradigm where more and more production is being produced by scrap, maybe the fair market value for scrap's $500 to $600. And if that's the case, you could say the fair market value on a long-term basis for steel maybe is closer to $800 or $900. I don't know how that's going to play out. I think it'll be a very interesting thing to see unfold over the next 6 to 12 months. But it does look like that's how the market's perceiving it as we see it today. But yeah, I mean, in terms of the trajectory of steel, if anything, it's gotten a little crazier and a little more panicky. I handle all of Ryerson's hedges, and we continue to do a lot of hedges for our customers to get them price certainty. And we haven't seen a big drop off in customer activity really on any of the markets, but even on steel, where we've got customers who are locking up prices in the $1,300 to $1,500 range, and they're comfortable doing it, which is amazing to consider. But I think there's some real panic out there in the marketplace, not just with prices, but also with availability.
I hear it. Yeah, exactly. And Nick, there's, we said we'd save questions for the end, but there's one that I think plays well to these carbon slides that you just outlined for us. And the question is, how do you see the changes in the Buy American requirements impacting this current situation, if at all? Does that have a big factor on this?
We talked a little bit about the infrastructure plan last month, and I think the answer is going to be similar in the case of Buy American. This is my personal opinion, it gets a little political, but if we're already in a shortage situation, given the current dynamics that we're in, and if we push things further towards domestic focused, the U.S. doesn't have enough steel capacity as it exists today to meet those demands. Now, could they flip on new mills? Absolutely, but in this current state, that doesn't seem to be in the cards just yet. So yeah, if there was a Buy American push, it would just further tighten things, but it would tighten something in a market that's already without enough steel. So it's almost like the semiconductor issue. If you said, hey, we need to buy more semiconductors and we'll pay more money for it, it's like, well, good luck, because there's no price where you can get them. It doesn't matter if you're willing to pay $500 for the $5 chip. There's no market for it. So I kind of see steel in a similar light, that if we continue to push more and more consumption towards domestic supply. Well, the domestic supply side doesn't really want to meet those conditions. So there's a mismatch, I think.
Yeah, and like you mentioned in the last time, you mentioned the infrastructure here again, but even if that gets turned on, I mean, that's not immediate, right? The demand's going to be probably out until next year too. So then you've got mills that are starting to ramp up production, and you'll see kind of the impact more longer term, right?
Yeah, I think so.
Okay, great.
And yeah, hopping over to aluminum, again, you're going to see very similar themes in a lot of these markets. So we're going to go somewhat quickly through these, but again, on aluminum, we look at the Shanghai futures market in blue. We're looking at the London Metal Exchange in white. We continue to pace higher. And these charts are, they're not gradually going higher. They're pretty knife edge sharply going higher. And it seems every single day we're coming into the market. Chinese markets are going higher. U.S. markets are going higher. And like I said, when you encompass or when you include the Midwest Premium, which is currently sitting at about 26 cents, we'll show a chart here in a second. When you take into account that spot number of 26 cents and put it on top of this, we're basically at record highs for LME aluminum ingot as well. So aluminum is in a similar situation, extremely tight, long lead times. Demand continues to improve, and we continue to basically be on allocation and in tight situations. So I guess my main recommendation, or one of my main themes across all of this, is make sure you stay very close to your sales reps within Ryerson to make sure that we can, or that we're working to try and get your volumes allocated. Because if customers have large growth expectations, we want to make sure that we hope that we're able to meet those, but in these types of environments, it's getting more and more difficult by the day. With that said, weirdly enough, I talked about the premiums on the front end of the curve being 26 cents. Very curiously, the shape of the futures curve for aluminum is steeply downward sloping. We call this backwardation in the futures world. And it's downward sloping to the tune of like 6 to 8 cents over the next 12 to 18 months. Why would that be? Why would that phenomenon be taking place? Well, anytime you're in a shortage market, the market tends to go in backwardation. It's the market's way of trying to incentivize more production, because it means that the price today is higher than in the future. So that's one phenomenon that's going on. But this is a pretty severe and starkly, downward sloping forward curve. It looks to me like somebody's trying to price in the expectation that tariffs, whether it's 232 or some of the common alloy investigations, some of those things get relieved. I'm not seeing a lot of headlines suggesting that that's the case, but just looking at this, there's certainly an expectation in the market that some sort of relief within aluminum premiums is going to come over the next 6 months or so. Again, we keep a very close eye on these sorts of things, and I'm not seeing that being, thrown around in the headlines all that much. But I look at this chart and I say something peculiar is going on within the marketplace, because there's an expectation that it's going to drop off pretty robustly over the next couple months. The other thing that factors in the premiums, it's worth noting, is premiums are often tied to how difficult it is to move product around. So it often is linked to freight rates or the availability of flatbed trucks. And as we know right now, the flatbed trucking industry is incredibly tight. Freight rates are extremely high. There could also be an expectation that at some point, if we see a lot of that labor that we talked about earlier coming back to the marketplace and coming in to actually move product around in a more efficient way, we could see that help to bring down premiums, because right now premiums are at record high levels. Just a quick aside, you can drive around and see billboards right now advertising. We talked about wage inflation, advertising for truck drivers that are paying 70, 80 grand a year. So you're talking about relatively low education type work needed for pretty decent pay. So I don't know if that's going to be enough to get people off the sidelines and get back to work, but whether you're trying to get a Lyft or an Uber or trying to get a truck and a flatbed, it's getting more expensive, and it's extremely difficult these days.
Might we see a bunch of autonomous shipments of autonomous vehicles carrying our metal around in the near future?
In the future, I love it. No, I think there's certainly a push that's the hope that we eventually get there. I think Lyft and Uber maybe maybe banking their entire companies on the expectation that eventually comes, and that'd be a great thing. I don't think that's going to happen in the next 12 months, but yeah, that could certainly be something. And then lastly, on the aluminum side, again, we look at all these mills, and they are profit generating organizations. A lot of them are publicly traded. You think about, are they incentivized to bring new production online? In this environment, they absolutely are. What this is showing is basically the blue line, which is your Midwest transaction price. So that's going to be LME plus premiums. You can see that we're basically at the highest levels, at least in the last 5 years, but in reality, they're at record high levels. And then the pink area is actually their cost structure. So that's going to be taking alumina, that's taking power prices, labor costs, things like that. That's going to be your pink area. And then you subtract those two and you get the light blue area, which is their profit margin, or their implied profit margins. And you can see that just over the last 6 to 12 months, profit margins at aluminum smelters have basically doubled relative to their 5-year average. So what does that mean? If you're an aluminum smelter, you're making a ton of money. And if you're an aluminum smelter, you are being incentivized by the marketplace to produce as much as you can in this current environment, because you can make money doing it. Again, there are bottlenecks, there are hurdles to doing so. I get that, but there is certainly a profit incentive to do so. And really, in all cases, whether you're talking carbon, stainless, or aluminum, there is very much so a profit incentive to do so. There are other reasons why that may not be exactly how they play it out. There may be a balancing act of, volume production versus what kind of margins they get. We talked about that on the carbon side. And then lastly, on the stainless world, we talked last month about the fact that that nickel had fallen off a cliff a couple months ago. That was all really predicated on the sense that Tsingshan had figured out a way to produce nickel matte for electric vehicle refined nickel production. They were producing that from nickel pig iron, which is a very abundant, cheap raw ingredient. When that happened, the price fell off and basically went from $9 a pound down to about $7.50 a pound. I got this one wrong. Last month I said, I didn't see any reason why nickel prices needed to rally, because as we look at it, and as many other market participants and analysts look at it, there's still quite a bit of nickel out there within LME inventories, Shanghai inventories. There doesn't appear to be a legitimate shortage of nickel. So when you look at supply demand fundamentals, that doesn't appear to be what's at play here. We talked to the CRU just a few days ago and asked them the question on why do you think just in the last couple of days we've seen such a substantial rally? Because you can see it here just in the last couple of weeks. Prices have gone from about $7.50 up to $8.10, $8.15. What's been the driver of that? And interestingly enough, their answer was because copper is going higher. And it's a bit of a flippant answer because you could say, what does copper have to do with nickel? If you take a step back and think about how a lot of these markets are traded, you always have to take into account the hedge funds, the money managers, people like that. And when they tend to get into trades, they oftentimes do it with ETFs. And one of the big ETFs would be the Goldman Sachs Commodity Index. You've got a Bloomberg index where you can just trade a basket of metals. So oftentimes, if a trader is just bullish the price of copper, they're going to get long or buy a bunch of contracts within these ETFs. And it tends to be a rising tide lifts all boats phenomenon. And interestingly enough, that was the CRU's response as to why nickel prices have rallied in the last couple of weeks, was just because everything else is rallying. So that can happen. Traders are usually okay with that because if they're trying to get into commodities or they're trying to get into industrial metals as a way to get exposure or potentially as a hedge to inflation, they may do it with these baskets, and sometimes we can see these phenomenons. So I wouldn't say it's anything specific necessarily why we're seeing nickel prices rise, except for the fact that just all metals right now are rising, and that's just the trend. So I know that's a bit of a simplistic answer, but that's the best I got right now. Fundamentally, I don't think we're running out of nickel, so I don't see us getting into any insane short squeeze situations or anything like that. And then lastly, I'm stealing a line from one of our marketing individuals, Jason Pounders. The chrome lining is in all of this is chrome prices are actually going the opposite direction from nearly all of the other metals. You can see it here in this chart pretty definitively. The price for Q2, which is $1.56, that's what's That's what the stainless mills are utilizing within their stainless surcharge. Since that Q2 reset, we've seen a fairly heavy bit of downward pressure on the price of chrome. And, you know, as we look at this today and we try and forecast what that might mean for Q3 or Q4, if this chart holds true for another, you know, couple months as we go into the Q3 reset, it looks like, based on this chart, chrome prices are going to be lower in Q3. And then the main reason for that is I think things overshot a bit for Q2. And from what we're hearing, China's actually producing a fair amount more chrome, ferrochrome these days, which is actually helping us just well supply the market. So a bit of fresh air. I know it's not much. It does kind of buck the trend of a lot of the other things and a lot of the other markets that we're watching. But this is, we'll end the presentation with a little bit of hopefulness on the cost side.
Absolutely. And Nick, looking just a simple question maybe, but when you look at stainless, I look at nickel and chrome, what does one tend to drive more than the other, or are they both pretty prominent in driving the price of stainless? I guess you see some positivity in chrome, not so much in nickel. I guess, is there any way to be more positive about one than the other?
Historically speaking, I would say that nickel had, and when I say historically, for the last 10 to 15 years, 20 years, I would say nickel was the preponderant driver to where stainless surcharges would ultimately go, and maybe even where stainless prices in general will go. More recently, though, I think that with this, so maybe 3-4 years ago, the European stainless mills made a switch going from a monthly index to a quarterly index. And when they did that, ever since then, the swings and the gyrations in chrome prices have been pretty dramatic. And you know, we've seen situations where we'll come in and just, you know, overnight, the next quarter's price is going to be up 50%. And when those things happen, those are absolutely having a bigger impact on the surcharge than nickel would. So I'm giving a bit of a fluffy answer because I think the two are becoming more balanced with regards to their impact on the price of stainless and the price of the surcharges.
Makes sense. All right, Nick, let's get to your public here. We've got some questions waiting in the queue. First, going back to when you talked about domestic prices and some of the data from China, one question coming in is, are domestic steel prices at a level where in imports from China or other countries, even at that 25% tariff, do they become more attractive?
So in the case of China specifically, no. And that's because, and again, this depends on the grade, but in the case of most steel products, the tariffs that are being applied to Chinese steel are actually not 25%. They're actually way higher than that. Call it 300%, 400%, 500%. That's not across the board, but that's in most instances. So what happens to be the case is with China steel, it's pretty much off limits for us here within America. Canada is a slightly different situation, although even they're starting to implement their own tariffs against Chinese steel. But if 25% was the threshold, then I think it can make sense still to bring in that product. But that's not going to be from China. That would most likely be from Russia or Vietnam or maybe Turkey or Europe. And though in those situations, yes, the spreads are there, and the tightness with regards to availability is such that I think it makes sense in many instances.
Got it. Here's one where crude oil prices. So as crude oil prices move higher, do you see that bringing more OCTG imports, or do you see that as an additional support for HR pricing moving even higher?
Yeah, sure. So at this point in time, it may, and shame on me for not having a chart in here, but we can talk anecdotally about it, and I can pull a chart in for the following month. But crude oil prices are starting to tick higher a little bit. I think WTI, West Texas Intermediate prices are right around 65. I think Brent crude oil prices are right around 70. I think that trend is, I mean, this is my personal opinion. It looks like crude oil prices continue to march higher, much like a lot of other commodities. But that being said, will that impact OCTG and steel markets? Yeah, I think as you see the health of the industry down in Texas improve, as you see crude oil prices improve, that tends to spark at least some level of CapEx and some level of investment into new new holes, new rigs, things like that. What I will say to counter that slightly though is many of the rigs. So if you look at like the Baker Hughes rig counts are still at pretty depressed levels, and in part that's due to horizontal rigs. So a lot of these, in a lot of situations, you can do a lot more with a lot less with regards to the number of wells you have to have in the ground. So that might stymie some of the demand. But generally speaking, yeah, if crude oil prices continue to tick higher, all things being equal, that should be one more industry that's going to demand at least a bit more steel. Yeah.
In full disclosure, I had to look up what OCTG actually meant.
That is
I found oil
tubular good.
Yeah, oil country tubular good. Yeah, gotcha. So we all learned something new here. So here's one where, this could be, we don't know if the answer or not, but mills suspending order entry. Do we know if that's a full capacity issue, or is that back to your labor discussion? Do you know if that has anything to do with either?
This is a tricky answer. I could give my opinion. I mean, I don't know for sure. I do think there's probably an element of labor issues. I don't believe that that's fully why steel mills are keeping some of their idled production offline. Again, these are profit generating institutions. I think they are trying to find a balance of keeping the market as tight as they can while still fulfilling as many customer orders as they can. I know I'm kind of tiptoeing the line a little bit, but we obviously stand in the middle of steel mills and our customers. So I want to be very cognizant of that. But no, I think they are recognizing that markets are tight, and I think it's more a function of, given the current availability of supply and given the current demand conditions, they are about as capped out as you can be. And admittedly, they're incentivized to keep it that way as long as they can. I don't think I'm crossing any lines by saying that. Steel mills want markets to remain tight and prices to remain high. There's no doubt about that.
Yeah, and to be fair, back to the labor chart you had, I mean, it's impacting everybody. So that's, yeah. So just time for a few more here. One, is there any insight into the availability of commodity grade stainless in the marketplace for the remainder of the year?
Say the beginning part again.
Do you have any insight on what might be the availability of like commodity grade stainless in the market?
It's tight. I mean, it's a very tight market. If incremental new tons are needed, if a customer forecast changes from plus 5% to plus 10%, that incremental 5% could be difficult to come by. I think the Allegheny strike and the Allegheny outage is further tightening that. So as we think about the balance of the year, for finished stainless availability and finished stainless lead times, it looks like it's going to be pervasive for the balance of the year, from what I can tell. And that's true not just within North America. We're hearing similar things within European lead times, basically extending out into early Q4 at this point. So similar story within stainless, and maybe even a worse story within stainless with regards to lead times. And yeah, that strike out of Allegheny is not helping anything.
Let's cap it off here with, you talked about your Dr. Doom hat before. I think this one's asking you to put your Nostradamus hat on, or you're projecting if Steel Stradamus, I guess, if for lack of a better name. Any predictions? And I know it's really tough to look for, but any predictions on when we might get back to normal, right? Time frame when things might get back to semi-normal.
I'm going to take a political route on this, but I think it can be helpful. I had an anecdotal conversation with a customer of ours a week or two ago, and I was talking about the fact that the labor issues were part of the reason why I think supply chains are broken right now. They're just very inefficient. Getting product to where it needs to be, both within North America as well as globally, it's not as efficient as it should be. And I mentioned that, and the person said, "It's funny you bring that up. I used to work in supply chain in, I believe it was Vietnam or Korea." And they said, interestingly enough, within that region, a lot of the manufacturing work is done by migrant workers. And they said, in this current environment, many of those migrant workers are not being allowed to go back to their jobs because of COVID. The reason why I bring that up is because I think it's a very good microcosm of what we're seeing in many of these instances where if labor is not allowed to be in the place where it's supposed to be and supply chains aren't able to operate as efficiently as they could be or once did a year and a half ago, then we're going to continue to be in these difficult, inefficient supply chains. So I answer that question with a very hopefully Nostradamus type answer, because it is a philosophical question of if you can tell me when labor gets back to work in a normal fashion, and you can tell me when these supply chains can operate in a more normal state, I think that would corroborate with when we see availability of goods improve and prices begin to diminish. I don't know whether that's going to be a 3-month phenomenon or whether that's going to be a 6-month phenomenon. I would probably make the argument that it's going to be a little regional dependent because certain regions are further along in the vaccination game and the return to work game than maybe other regions of the world are. Take India, take Brazil, who are really kind of in the thick of it right now on the negative side. So I think it's going to be regional, and that might cause little pockets of outages along the way. But that's a really difficult question to answer because if you can tell me when people are back to work in a normal way, that would be your answer. But I don't know when that's going to be.
Yep. Good answer. I think we pushed your limits today, Nick. I mean, excellent. I'm going to do a little housekeeping here, but then I'm going to kick it back to you to give a closing thought and a key takeaway that everyone can have from this. But for those of you who want to replay this or even see snippets of it, go back to Ryerson.com starting early next week. We'll have the full video here as well as some snippets of here and then snippets of this Cup of Joe. And if you want to sign up for next month, there will be a form to fill out to sign up on an email to get regular updates on when the next Cup of Joe. We aim for the first week or so of each month, but that could change. So Nick, and before I kick it back to you, I do want to thank everybody for taking time. Like I said earlier, you can be anywhere, but we're glad that you've taken your coffee or your afternoon beverage to be with us and look a little bit about what's going on in the marketplace. So without further ado, Nick, a little closing thought, anything, key takeaway, something?
Yeah, for sure. I mean, we presented the main topics that we think are important or that I think are important within the landscape of the manufacturing community. And we're doing it within 45 minutes, but honestly, in this environment, I mean, if you turn on CNBC right now, inflation and supply chain issues is probably topic number one in the entire business world right now. We could spend days talking about this. The reason why I bring that up is because if there are other specific items that you'd like us to discuss in next month or in subsequent presentations, we are all ears. Send that our way, send that through your salesperson. We're more than happy to talk about some other items. There's so much to talk about that we can't do it in 45 minutes. So we apologize for that. We're doing our best that we can. But in addition to that, if there's ever reason to hop on a one-on-one call with Ryerson and our customers, we're more than happy to do those things as well. And shameless plug, we do offer hedging services. I mean, one of my roles is to actually help customers lock in prices for the product that they're already consuming from Ryerson. So that may be something that makes sense in certain areas. I know it's a tough pill to swallow because we're currently at record high prices in many of these markets, but it's at least something that we can be talking about. And I hope that we get to the point one day where we have less to talk about, because that hopefully means that markets have normalized and it's easier to get you the material than what we have today. Right now, there's just a ton to talk about, and we welcome anybody's feedback as we continue to go along. But thank you everyone for your time. And we look forward to doing this again next month.